Hello, I would like to welcome you all to this evening's presentation on improving your financial well-being, brought to you by the Lohana Professional Network, which is part of LCUK, that is Lohana Community of United Kingdom. LCUK created the professional network with a view to providing a forum and a platform for our members to meet, exchange ideas, and network for personal and professional development. LPN had been dormant for the last few years, and we thought this would be as good a time as any to restart it. So the first event was held last month on the 14th of May, and today is the second one. Once the lockdown is fully lifted and it is safe to organize physical networking events, we will look to do so. So if you have any suggestions for LPN on what topics to discuss or what type of events to organize, then please get in touch with us. You can email us on lpn@lcuk.org.uk. Without taking more time, I would now like to invite Mr. Sunil Majitia, the President of LCUK, to say a few words, and then we'll start the presentation. Thank you. Mr. Sunil Majitia, please.
Hi, good evening and welcome everyone. I'm Sunil Majitia, President of Lohana Community of United Kingdom, of which Lohana Professional Network is part of. Although formed several years ago, LPN has been inactive over the last few years, and it was always our intention of reviving it. This lockdown provided us with the perfect opportunity to do so. Our first event, held over a month ago, was on the Zoom platform and proved to be a success. And on the good feedback we received, we've decided to have a second event tonight, with it being on Facebook Live rather than Zoom, so many people can participate. In future events, we'll use either platform to hold events. Tonight's event is quite appropriate to the current situation, improving your financial well-being, presented by Ronak Paw, who is a financial planner and a member of the Chartered Institute of Securities and Investments. Ronak will talk through some helpful tips on financial well-being. I hope you all find it helpful and useful. So without further ado, I'll hand you over to Ronak. Thank you.
Good evening, everyone, and thank you, Sunil Bhai, for that nice introduction for myself. Hope everyone's well. Hope everyone's doing well during, obviously, the COVID outbreak and staying home at this moment in time and staying safe. Today's session, as Sunil has just said, is an introduction to financial well-being. Hopefully, I'll be able to give you all some tips and just some useful bits of information with regards to financial well-being today. My job, I am actually a financial advisor, and I also go out doing presentations very similar to the one I'm going to do today for you, with lots of different companies out there and for employees of different companies out there. I will switch off the video shortly and start sharing my screen so that at least you can see the slides in large. If there's any problems or any issues, or you have any questions at all, please feel free to drop them in. If you're watching live, drop them in on the Facebook Live chat or whichever platform you're watching. We've got people watching on all the different areas. Just pick up those questions and they'll be forwarded to me through a Q&A session that we're going to have right at the very end. Hopefully everyone can hear well. If you can't, again, just drop it into the Facebook chat, the Facebook comments, and one of the team will pick it up, hopefully, and we'll get that issue sorted. So without further ado, I'm going to share my screen, so bear with me a couple of moments, and I will just do this. So while I share my screen, I'm also going to stop the video so that you can see the slides in full, and I will start going through. So once again, my name is Ronak Paw. I am a financial advisor. I do work for a company called Consolidate Asset Management. Effectively, they give financial advice to a number of different companies and a number of different employees through the companies as well. My job, like I said before, that I do go out and do these types of presentations, as well as giving financial advice to a number of different clients that I actually look after myself. Today is all about me giving you information, though, and I want that to be very, very clear that I'm not giving you any particular financial advice. It is all about information. The presentation I'm doing today has been put together by my company and myself, and all the information within it is there to just give you information. It's not there to say definitely take it away and act or rely upon any information I'm giving you throughout this presentation. A couple of other things just to remember as well: past performance is not a reliable indicator of future returns, and all investments do have some form of risk as well. And any of the tax benefits I'm talking about through this presentation, they are subject to any potential changes over the years as well. So do look out for any changes that may happen over the coming months and years. So what I'm going to look to cover in today's session, well, effectively, we're going to talk about the 7 steps of financial well-being. We'll talk a little bit about making good pension choices. We'll have a bit of an overview of the world of investments, and I'll also talk a little bit about tax hints and tax efficiency as well. And finally, I'll end with accessing advice on whether you can do it yourself or the pros and cons of both of them as well. With regards to what the session won't cover, well, I'm not going to provide any financial or tax advice directly. Once again, it is just information. It is not me giving you exact financial advice for any individual person out there. It's looking at generic planning objectives and giving you some food for thought to go away and sit down with your own financial advisors, or if you want to get in touch with myself or other financial advisors within the community, then you can feel free to do so as well. What I won't also be doing today is promoting any particular financial product or any particular company. Although, like I say, I work for a particular company, which I mentioned before, I'm not here on behalf of Close Brothers today. I'm here just as someone who helps in the community. I would like to give some information out there for free to the rest of the community. Money worries. Well, money worries is something that I feel quite passionate about. Money worries don't just affect your bank account at the end of the day. Money worries can affect your financial health, they can affect your physical health, and they can have a big impact upon your life. So at this moment in time, during the COVID-19 outbreak, money worries is probably at its highest level ever. Lots of people are starting to get new money worries, whether that's through not being able to work, whether it's dipping into their emergency funds or their savings that they have, or whether it's just actually that they've just got not enough money at this moment in time after being furloughed. So there's lots of people out there that are being affected by money worries, and that's why I think it's a great time to focus on this. You know, at the end of the day, there are lots of people out there that can talk to you about your finances and talk to you about your investments, but there are very few people out there that will actually help you act on your money and act on your money worries that you may have. So today's session, like I say, we'll just spend a bit of time talking about various different things with regards to finances. I will focus on 7 different steps to financial well-being, and those are the first one being planning and budgeting, the second one being managing debt, the third one being protection, the fourth one being retirement planning, the fifth one being savings and investments. We've got property and mortgages, and the final one, again, which I feel is a very important one, is tax efficiency. If we start off with the budgeting and planning top tips. Now, the first thing I'll say with regards to a budget or looking at planning as well is that it's something you should look to do once a year or when your circumstances change. If you don't do a budget or you don't do a plan, then without sounding too cheesy about it, if you don't make a plan, you do plan to fail. So I think it's really important that you do have some budgeting and planning ways that you can use in for your finances. Now, it's easy to turn around and say create a budget or create a plan. It's much more difficult to actually put those down on paper or actually put them together. But that's what most people think. A budget or a plan doesn't need to be complex. It can be just as simple as just a one-off spreadsheet. It could just be a simple Excel spreadsheet where you look at your income versus your expenditure, your assets versus your liabilities, what your goals are, and whether you're actually on target for hitting those goals. So it doesn't need to be anything complicated. But if you're really, really stuck, then there are lots of different apps that you can use, and there's some apps that are listed here just at the bottom of this slide. So you could utilize an app like this that will help you to actually put a budget together and a plan together for your money as well. What should be included in your plan though? Now, I can't go through everything today and say exactly write a plan like this or give you example plans as such, but what I can talk to you about is the types of areas that you should focus on. Before I do move on to that though, a word that you're going to hear me say a lot today is the word individual, because everything is individual. Everyone's circumstances are different and everyone will focus on different areas of their life as well, and different things will be important to different people. So every single person is individual. So when you're talking about what should be included in your plan, well, you should be looking at your assets versus your liabilities. It's pretty much common sense that you'd want to have your assets above your liabilities, and you want to make sure you pay off your liabilities as quickly as possible. You also want to look at income versus expenditure, so making sure that you've got enough income that covers your expenditure, and actually that you have some surplus income as well, and then you start to decide, well, what do I do with this surplus income? You want to set yourself some key goals and actually create a timeline for yourself as well. You need to make sure you've got a level of security in place. So if you're taking risks, do you have some form of protection in place as well? And also making sure you look after your own family and future generations that will come. So all of these 5 things need to be included in any type of plan that you're looking to do. Just a bit of an idea with some of the things that might come up throughout your life and things that you may need to plan for as well. So it may be that you've got yourself or kids' university fees to start to think about, getting your children on the property ladder. There may be estate settlements. So it may be someone in your family's passed away and left you some money or left you an asset. You may have your mortgage that will get repaid. You'll then have children's wedding costs, potentially grandchildren as well. As we move further on down the lifeline, you'll have things like retiring from work, enjoying your hobbies, downsizing your main home, and starting to look at wealth transfer planning, passing your assets onto your children as well. And a big one that a lot of people forget about is care home costs there at the end as well. Care home costs in the UK can average around £50,000 a year. Therefore, you might look at your money and say, right, I've got a couple £100,000 in the bank account, and that's fine, you know, that will see me through retirement. Sounds like a lot, but £50,000 a year means you'll only survive 4 years in a care home. And now with lots of changes out there through the policies that the government have introduced, actually, they can start to actually sell your assets in order to pay for care. So it doesn't mean that if you've got no money in the bank account, that they can't go after your house, or they can't look at what you've transferred to children or other people and start actually claiming some of that money back to pay for your care costs. So care home costs is something you really do need to consider. Another important point that I'll just point out on here is just with regards to retirement. You can see that retirement is actually halfway through this timeline. So if I go back a slide, you'll see the university fees and all the different things that come up. Retirement is halfway through the timeline. And the reason why that is, you actually spend your working life of around 35 to 40 years, followed by retirement. Now, if you feel that a retirement is around the age of, say, 65 odd, or you can retire from the age of 55, and the average life expectancy in the UK goes to around 83, 85. So you can spend retirement as around 15 to 30 odd years, and for some of us, maybe even longer. So retirement isn't seen as the end of your life. It's seen, as this timeline shows, as the midpoint of your life, or the new beginning, as a lot of people look to call it. So you do need to plan and save for your retirement. Otherwise, you won't have enough money available to you at that moment in time. The planning and budgeting across all of these different areas is very important. The second tip that I'll talk to you about is looking at debt and managing your debt. Now, with debts, there's good types of debt and there's also bad types of debt. And we'll talk about some of these in the next slide. But you also need to be able to prioritize your debt and know which ones you want to pay off quickly and which ones you might want to take a little bit of time paying off. It's really easy to get into debt troubles. If you do get into debt trouble, it's really important to get help as quick as possible. I know within our communities and the Asian communities generally, and apologies for making a generalization here, but generally it is seen as a bad thing to be in debt or to have too many debts. But if you feel yourself getting into problems, do speak to someone and do turn to someone as quickly as possible. Managing debt, like I say, it shouldn't be a problem that you should ignore. If you feel there's a problem, speak to someone, be it your bank, be it the Citizens Advice Bureau, be it a financial advisor, be it a friend as well. Speak to someone, open up about it, because debt is the #1 reason why people will get into kind of depression or other things through financial worries or financial well-being as such. So debt is one of the worst ones when it comes to financial well-being. So understand your debts, know what's going on with them, and then decide what can I do about it and where can I go for help on it. With regards to debt as well and managing debt, it's also important to keep an eye on your credit score, looking at things like your credit history, your address history, making sure that's updated. Make sure you make all your payments on time. If you are struggling with your debts, the minimum you should be doing is making sure that the minimum payment is met. It will still take you a long time and cost you a lot of money to pay off that debt, but it will keep your credit score green as well. If you've got any dormant accounts, so any accounts that you haven't used in a long time, it's always important to get them closed off. If you've got financial links with any individuals, so people that you live with or people that you used to live with, make sure that they're accurate on your credit file. Check your file for credit fraud. Happens a lot, unfortunately, out there right now, especially in times like this. So do check your credit file for any credit fraud it may be. Try and minimize credit applications. Do you really need to have 10 credit cards, or can you get by with just the one actually? And also make sure your electoral roll details are up to date as well. So these are all things that you should do via your credit score, which you can get by going to companies like Experian online and paying a small fee and getting it. Or lots of credit cards nowadays actually offer this for free as well as part of the benefits that they have. So it's worthwhile looking into your credit score as well. So just a quick slide on some different types of debt that there are available out there. Pardon me. The first one is a credit card. A credit card can be seen as good debt or bad debt. It can be repaid each month. So if you're paying off your balance in full each month, or you're on a 0% card, it can be seen as a good style of debt to use. Don't get me wrong, I'm not suggesting to anyone that you go out there and actually sort of build up balances on your credit card, but it is a good thing potentially to use if you're getting things like cashback, or you're getting points on your card that you're able to utilize as well. So there's lots of cards out there that can give you benefits and can be seen as good style of debt as long as you repay it every month. The mortgage, I think, is probably the only debt out there that is generally seen as a good type of debt in all lights. The reason why is because it allows you to buy your house. For most of us, it will mean that it's the only way that we can get onto the property ladder, and it also means that we can pay off that debt over a long period of time with lower rates of interest. A bank loan is another way of borrowing money on a cheap way, but it should be looked upon as something that's not too longer term, but also you should never look to borrow more than the value of the asset or beyond the life of the asset. So for example, if you're using a bank loan to buy a car, then there's no point having a car loan that's going to last 20 years because your car is probably not going to last that long. But at the same time, you don't want to take out a £50,000 loan for your car when the value of it is only £30,000. So you need to be careful from that side as well. The three at the bottom, so the overdraft loan, the overdraft as such, is something you should try and avoid. Although it has similar rules to the credit card, unless you're going to pay that overdraft back straight away, you shouldn't be using it. Again, it's something that I think a lot of people do look at and think, oh, I've got the overdraft, I might as well use it. But actually, the fees and charges that are associated with an overdraft can sometimes be quite extortionate. I know a lot of them have been frozen right now during COVID, and yes, if you do need to dip into them, then do so rather than failing to make a payment elsewhere. But only try and use them if you really, really have to. Payday loans is probably the one on here that most people will look at and say that's a bad type of debt. And yes, I agree, you should try and avoid it if possible. I'll say something a little bit controversial here though, and that is that, again, it comes down to individual circumstances. A payday loan is definitely seen as bad debt generally, but actually there are some instances in where it could be utilized in a good way. To give a quick example of that, if, say, for example, your car had broken down, you need to make some large repair costs on there, and the only way you can do it is by getting a payday loan to pay for those repair costs to keep you going to work and keep your money coming in, and a bonus is coming through at the end of the month. Well, actually, to take a payday loan and pay it off at the end of the month isn't such a bad thing to be doing. However, only do that if you can't use your credit card or a bank loan or other areas like your overdraft to get that type of finance to get you going again. So in the right circumstances, it can be used, but again, I would say avoid it if possible and try and look to use some of your other types of debt if possible. A season ticket loan is quite the opposite. A season ticket loan is generally seen as an employee benefit. So if you're working for a company out there, a season ticket loan isn't your football ticket loan. It doesn't mean that you can get your football ticket for free or anything like that. A season ticket loan is where you can get your travel card for free. That's paid, oh, sorry, not for free. You can get your travel card paid for the year and you pay it back monthly. The benefit of doing that, if you take a yearly travel card, it generally is more cost effective than actually taking a monthly one or doing pay as you go. So it's available for most employees. Again, have a word with your employer if you feel it's something that's relevant to you. Lots of different types of debts and lots of different types of good debts and bad debts, and some that we look at that you may feel could work either way as well. So the next area, number 3, I'm going to look at is protection. Now, protection can be generally looked at through things like life cover, critical illness cover, income protection, or family income benefits. These are all types of policies or insurance that you can take out that will cover you for various things going wrong. It's really easy to sit there and plan and say, I want to have this in the future, I want to have that in the future, and I'm going to save X amount a month and that will achieve my goal. But what happens if something goes wrong? What happens if you do get hit by a bus tomorrow? And God forbid it happens to none of you, but what if you did get into a situation where an accident means that you can't go to work for a sustained period of time? Yeah, your sick pay may cover you for a certain amount of time, but will an income protection plan pay you for even longer? Will a critical illness cover policy pay out because you've been left in a wheelchair? Will a life cover policy pay out if you were to pass away and allow your children to still go to school or have the education that you wanted them to have? So it's really important to make sure you have the right types of cover in place. Again, today I'm just giving you some food for thought on the different types of policies that you can have. I won't give any exact examples on this, but do speak to a financial advisor if you feel you don't have enough cover or want to have more details about these particular types of cover. Emergency funds is also a style of protection. By emergency fund, effectively, I mean a rainy day fund. It means keeping some money aside so that if something was to go wrong, then you have a lump sum of money available to you that you can actually dip into at any moment in time. How much should you have? Well, generally speaking, we say you should have 3 to 6 months worth of your expenditure available to you. So if your expenses every month are £2,000 a month, you should have somewhere between £6,000 and £12,000 available to you in a cash access, easily accessible account. Be careful with Fscs limits, so the Financial Services Compensation Scheme limits, but also don't keep too much there as well. It's easy to turn around and say, I'm going to keep £50,000 in a bank account, which is great, but actually, is that the right way to be keeping a large sum like £50,000, or should you be putting it somewhere else to better use and only keeping £5,000 or £10,000 available for you? So again, it's individual, it's different for everyone, and it should be regularly reviewed as well. Another thing on the protection side that I'll mention is looking at wills and lasting power of attorneys. Now, a will is something that is so simple to do. It just means that if you're to die, it means your beneficiaries will get your estate in the way that you actually want it to happen. A lasting power of attorney means that if you were to be incapacitated or unable to speak for whatever reason, or unable to communicate what you want to happen, then effectively by having a lasting power of attorney, whoever that person is, they're able to make decisions on your behalf. Now, again, with a will, most people turn around and think, oh, if I die, everything goes to my wife, everything goes to my husband. That's not necessarily the case, and I'll cover off some of this a little bit later on. And with a lasting power of attorney as well, everyone thinks it's not going to happen to me, it won't happen to me. But actually, if you look to try and put in a lasting power of attorney when you actually are in that position, it's too late. You need to do it when you're of sound mind and you have clear thoughts to be able to actually have that approved. So it's something you should consider whatever age you are, because you could walk outside and get hit by a bus, like I say, and therefore you will need a will or a lasting power of attorney at that moment in time. Also, with regards to workplace, and again for employees, if you're working, does your workplace offer any of these protection things? Do they offer a will service or an LPA service? Or do you have free life cover or critical illness cover available to you? Or can you top up those things through work? So do look at what benefits are available to you with regards to that. And with regards to coronavirus right now, has this focused your mind on this need? Because you know that you're able to see firsthand that if you were unable to work or you weren't having your income, what sort of impact that would have on your family. Now, right now, it's not such a drastic impact because a lot of us are staying home. We don't have extra expenses. But imagine you were living your normal lifestyle. Would you be able to sustain that if your income wasn't coming through? So it is something that you do really need to consider even more while coronavirus is around. Step 4, so talking about retirement top tips, and I'll spend a little bit of time going through this in a couple of different ways. The first one is to kind of say that pensions are still the foundation of most ways of retiring. So most people will have pensions available to them through their workplace, or they'll be saving into pensions themselves, and therefore they have their own private pensions. It's something that you should review annually at least, if not more often. And one of the biggest things that I would say with regards to pensions is to nominate a beneficiary. It's very similar to a will. It basically says, when I die, this is where I want the money to go from my pension. You spend a lot of time saving money into your pensions. If trustees of the pension service don't know where to pay that money if you died, they won't pay it out. So you do have to have a nominated beneficiary. So if you only take one thing away from today's session and you're employed, then go away and ensure you have nominated a beneficiary for your pension. And also make sure you keep up to date contact details with all of your pensions and all your old pension providers as well. Pensions, like I say, is the main thing that will fund your retirement, but there are other things as well. There'll be the state pension potentially, and we'll talk about that in a couple of slides' time. There may be other investments, or it may be that you look to carry on employment. Lots of people nowadays retire as such at the age of 55 and onwards, which is when the earliest date you can retire, but will carry on working. It just means they're able to access some of their funds through some of their previous pensions. So there's lots of things that you can do as well as continue working when you actually hit retirement age. And how much would you need? Well, again, it's individual to everybody, but an average is about £27,000 a year for a single person. For a couple, it's slightly higher than that, but not too much higher, because you have to think a lot of the expenses are joint between the husband and wife. Remember that there's a difference between employed and pension income. And I'll talk to you about this in a bit more detail in more slides' time. With regards to different types of pension, again, I could sort of spend ages talking about pensions today. I'm just conscious of the fact that we've only got an hour today, and today was a bit of a kind of overview of finances. So I'll have a bit of a discussion with you with regards to pensions now. But if you did want any more information, again, speak to a financial advisor, or depending upon the feedback we get today, I may be able to do another sort of session that specializes just on certain aspects of certain areas. If you've got any questions or anything, or any suggestions with that, please do drop them into the comments boxes on the various Facebook pages. So there's lots of different types of pensions out there, but realistically, there are two main sort of styles of pension. You have what we call a DB pension, or a defined benefit pension, which a lot of people out there will call a final salary scheme. And the other type is a defined contribution scheme, or a money purchase style scheme. If I talk about the final salary or defined benefit style scheme, effectively, what that means is if you're working for a company, what they do is they say, how many years have you been working there? What is your final salary when you leave that, or when you retire from there? And they do a calculation between the factor of how many years you've been there. So the factor is normally somewhere around 1/60th, or could be anywhere up to 120th as well. What I mean by the factor is for every year you've worked there, they will give you 1/60th, for example, of your final salary as a pension. So for example, if you'd worked for a company for 30 years and your final salary there was £100,000 and it was a 1/60th scheme, you'd get 30/60ths, which effectively is half. So you'd get half of that 100,000, £50,000 as your pension. There is no investment content. It's not invested in funds. You don't need to worry about the prices going up, or unit prices going up, or the investment returns being better or worse. It's all about how many years you've worked there and what your final salary is, and that's it. Nothing else comes into it. With regards to a defined contribution scheme is like a giant savings account. It's essentially, you save money into there, you can pay money in, your employer can pay money into it as well, and you're just creating a savings pot, a giant savings pot. When it comes to retirement, you have a decision to make on whether you buy an annuity, or whether you take a lump sum out of there. And with lots of changes in the rules on pensions recently, you actually have the ability to take as much or as little as you want from a defined contribution scheme. The benefit of a defined benefit scheme over a defined contribution is that the pension income is guaranteed. So on my example that I used, where I said there's £50,000 as the income, it would be guaranteed for the rest of your life until you die. So if you live 30 years, 40 years in retirement, you'd always get paid that money. In a defined contribution scheme, if you decided to go into what we call drawdown, which is where you take money out as and when you need to, the money will eventually run out. So for example, if you had a pot of money that was worth, say, £500,000, and you took 50 grand a year out of the pot, and after 10 years, or just after 10 years, taking into account a bit of interest, you'll probably have no money left in the pot, and therefore you won't have pension income available to you. So you do need to balance it as to how much you're taking out and how long you feel you're going to live in a defined contribution scheme. And that's why a defined benefit scheme is seen as the best ones out there, because they guarantee you a pension for the rest of your life. But it's just as important to have a defined contribution scheme, because a lot of the defined benefit schemes are no longer in existence or being phased out by a lot of companies. The other pensions that are mentioned on this slide, so you've got a GPP or group pension plan, is a type of defined contribution scheme that's run by your group. You get benefits of cheaper charges on there and benefits of your employer and yourself giving contributions to it as well. A SIP is, again, very similar to a defined contribution scheme, but this is a personal pension, so it's a self-invested personal pension plan. Works in the same way, but you're the only person contributing to it. You're still accumulating money in a large pot, and then at the end you have decisions to make, which I'll talk about on the next slide as well. And there's also your state pension that's available to all of us out there, depending upon how many national insurance contributions we've made. And again, I'll tell you some more accurate figures on what you can get from that pension in a couple of slides' time. So from a defined contribution style pension, I mentioned there's lots of options available to you. So you can take 25% of the money tax-free as a lump sum from the pension. You can draw down all or part of the money. You can take an annuity. An annuity is buying an income effectively, or you can do a combination of all of them. So a defined contribution scheme gives you lots of different options and are very, very flexible. A defined benefit scheme just says to you it's going to give you X amount, so that in my example I mentioned earlier, £50,000 a year, and that's the option that you get. You can take a bit of a lump sum from those style pensions, but once you've decided what you're taking, that's it, it's stuck on that. Whereas in the defined contribution scheme, you have options that you can make throughout the different lifetime of the pension. Again, I've gone through things quite quickly there and kept it very high level and just dropping in some bits for you to kind of think about as a food for thought. If you want any specific advice on anything I've spoken about there, do contact a financial advisor or contact myself if that's what you'd like to do. My last bit on pensions is just a little bit around kind of looking at employed income versus pension income. And this all comes back to step number one, really, with regards to your budgeting and your planning and what you're looking for in life. With your finances, your income right now may be £50,000 through employed income. But if you break that down as to what you actually take home on a monthly basis, and you can see an example, it's around £2,861 after you've paid your tax, your national insurance, you've paid your pension contributions potentially, and various bits. So you can see on there that if you were to think, right, my pension's going to only pay me £25,000 a year instead, normally in your mind you'd be thinking, right, I'm only going to get about £1,400 a month based on that left-hand side. But actually, if you look in reality, now you don't have to make a pension contribution. You no longer need to pay your national insurance contributions, and therefore your net income is about £1,875. So the difference there is about £986 a month, which, don't get me wrong, is a large difference, but it's not quite as large as what you think. So what I'm really trying to show you here is that 50% is not really a 50% drop. Yeah, 50% here actually equates more to a kind of 30% drop in this scenario. What to expect from the state? Well, actually, the state pension, despite all the things that people say about the government, is actually pretty good. You end up getting just shy of £9,000 a year, so £175 and 20 pence a week is what you get through. You do need to make contributions of national insurance for 35 years in order to qualify for that. So you do have to make sure you're paying your NI contributions all the time. If you're self-employed, you're still entitled to this as long as you keep up your national insurance contributions as well. So it's something that I think the government has done really well to keep around. How long it will be there for, we don't know. But actually, it's something out there that is giving us some money in retirement and can help you. And if you add this to your pensions that you may have through your workplaces or personal pensions that you've done, it actually will top up those pensions. So if your pension looks like it's going to be £15,000 a year, you may look at that and go, is that going to be enough? But add another £9,000 to it and it becomes £24,000 a year. Suddenly you're looking at a couple of £1,000s a month and you're thinking, I can live off that. That's a substantial amount to be living off. In order to find out whether you have been paying your NI contributions correctly or how many years worth of NI contributions you've made, you can get a state pension forecast. It's called a BR19 form. And you can log on to the website that's listed on this at www.gov.uk/check-state-pension. And that will give you a list that will say every year whether you have completed enough national insurance contributions or not, and give you a total at the bottom of how many years you've paid. Once you've paid the 35, you don't just stop. You do have to keep paying until you actually retire. But if you pay them over the 35 years, then you will qualify for the full state pension. Reviewing and making pension changes, just some good housekeeping bits on here. All pensions will have a modeler, so it's really important to utilize the modeler. Go on and use the online platforms that will allow you to say, right, if I retire at this date, what will I get? If I retire at that date, what will I get? If I increase my contributions to X amount, what will I get? And so on and so on. So do use the modelers, look at your statements and understand where your money actually is and where it's being invested. Review your contributions and think, right, can I add more to my pension? It's sufficient to do so. So can I put more into my pension or not? Again, nominate a beneficiary. I can't reiterate enough how important that actually is. Make sure the date of your intended retirement is correct and ensure that the investment choice of where the money is being invested matches what you're looking for from your investments as well. So again, just a few helpful hints around reviewing and if you want to make changes to your pension. We look at step number 5 and moving on to talk about savings and investments. Well, savings and investments are something that fits in with your financial plans and probably is the bulk of your financial plans. And there'll be short, medium and long-term investments you want to do. But again, it's important you regularly review them as well. And again, make sure you look at workplace benefits. So there are things like share save plans. Are there pension options available to you? Or are there bonuses that you can pay into investments direct that can then become tax efficient for you? So if you're employed, look at those. If you're self-employed, then actually, are you actually taking money out of your business in a tax efficient way and investing it in a tax efficient way as well? Again, this is always going to be individual. So it comes down to what are your financial goals? What are you looking for from your money? What access do you need to your money? Or are you able to leave it invested for a number of years? Or do you need to actually have unlimited access to the money? What sort of time period are you able to invest for? If you're able to invest for less than 5 years, then realistically cash products should be the area you're looking to invest in. If you're able to invest for more than 5 years, then it may be other investment types that you're able to look at and you're able to take some type of risk as well. Risk is something that you have to take with your money in order to be prepared, or you have to be prepared to take with your money in order to get better financial returns. And there's risk in anything that you do, but there's also a risk in doing nothing as well. If you did nothing and you left your money under the bed, there's a risk involved in that. And we'll talk about this in a few slides' time with regards to inflation risk that will actually come in. But just a couple of seconds on this risk side of this sort of pie chart that you can see here. The main two I see on here is your attitude to risk and your capacity for risk. They're very, very different. So if you're going out there speaking to a financial advisor or you're looking to invest some money yourself as well, everyone thinks, I don't want to take any risk with my money. If you don't take any risk with your money, then you're not going to get the potential returns as well. So you have to take some form of risk. And a lot of people will say, my attitude to risk is low. Just straight away, as soon as you meet them, I want low risk. But actually, the capacity to withstand losses is a lot more. What I mean by that is that if you were to invest £100,000, then if you lost all that money, would it have an effect on your day-to-day lifestyle? Yes, you'd be really annoyed that you've lost £100,000, but is it affecting your day-to-day lifestyle? If it's not affecting your day-to-day lifestyle, then you are prepared to take a higher risk with it. If it will affect your day-to-day lifestyle, why are you investing that money in the first place? Because you can't afford to take any risk with that money. So they're two different things that very often get confused. People say, I can't afford to lose any money. I don't want to lose any money. There's two different things there. So just, if you are going to speak to a financial advisor, do remember that point with regards to risk. So when it comes to savings and choices, you should only be really looking at savings and investments once you've looked at managing your debt and created a rainy day fund for yourself, which we've spoken about already. Once you've got your debts under control and you've actually got your rainy day fund in place, that's when you want to look at your second line priorities with regards to things like pensions, ISAs, share save plans, or share plans, share investments yourself, or other styles of investments as well. But not until you've actually set up your rainy day fund and you start to manage your debt should you start to look at any of these areas. So do bear that in mind when you are looking to think about investing your money. Inflation. Now, inflation is something that does eat into your money. At the end of the day, if you invest money, then you'll have a chance of beating inflation. If you don't invest your money, then and you left it just under the bed, And like I mentioned before, inflation will start to erode at your money. Here's a graph here that does show you the effects of inflation over a period of time. However, I put it into more simple terms with you. When I was a kid, and giving away my age a little bit here, but 25, 30 years ago, you could actually go and buy a Mars bar for 20p. So I could walk into the shop, pay 20 pence and get a Mars bar. If I had £1 on me that day, I could buy 5 Mars bars. And trust me, I did when I was a kid. So I could get 5 Mars bars for my £1 about 25 years ago. Today, if I go down to Liverpool Street where my office is and I try and buy a Mars bar there, it costs me closer to £1.20. I can't even get a full Mars bar. I know the clever people will turn around and say to me, if you go to Tesco, you can get 4 bars for £1. They're not the same. They're not the same size. I'm talking about an individual bar. You go to an individual shop and try and buy an individual Mars bar, you will see that actually it costs you £1 or more. So my £1 back in the day that could buy 5 Mars bars can only buy 1 now. And that's the effect of inflation. And in the same way, this is what this diagram is showing you on here, that if you left money, under your bed or left it in a bank account, after 5 years, your £100,000 would be worth £90,000 at 2% inflation. And if you go all the way to 20 years, it could be worth as low as £55,000 at 3% inflation. So if you do nothing with your money and you leave it in a bank account, over a course of 20 years, you've nearly half the value of your money. A little bit in regards to income and growth choices and the different options that are available out there. There's lots of things you can invest your money in and lots of different asset classes you can invest your money in. And this is what we're looking at here. So you've got things like gilt, government bonds, you've got deposit accounts, you've got corporate bonds, there's lots of alternatives, things like cryptocurrencies, things like gold, things like carbon, things like that now. You've also got property and you've also got individual stocks and shares as well. So there's lots of different areas and lots of different asset classes you can invest your money into. Generally speaking, you'll say the right-hand side of this is a little bit more risky than the left-hand side of this, but there are still areas that you can invest in and still minimize the risk overall. The next slide starts to look a bit complicated, but it is quite a simple slide once I explain it to you. What the different colors represent are different asset classes, and you've got the years across the top, so from 2007 to 2019, and the performance of those asset classes in those individual years. The reason why I'm showing you this is that most people will tell you you need to diversify and invest in different areas, but what's the reason why? Why do you need to have a balanced portfolio or invest in lots of different things? Well, the main reason why is because nothing out there performs consistently producing returns. So for example, if you look at 2007, you'll see the grey box at the top, which is oil, produced 55% returns. The following year in 2008, it lost 36%. You then look at 2016 at the top, it made 73%, but 2018, it lost a further 20%. So it's sometimes at the top, sometimes at the bottom. The same with Japanese equities. In 2007, it's at the very bottom at 6.61% loss. But in 2015, it made 16.86%. So no one asset class is constantly at the top, and no one asset class is constantly at the bottom. So you do need to invest in lots of different areas. But the question I would ask all of you is, can you do this yourself? Probably not is the answer, and that's why you should look to speak to financial advisors. Again, I'm not saying it has to be with me or my company, but do get help and get assistance in actually investing in this type of way. As we move over to number 6, and just conscious of time a little bit, I'll speed through the last few slides that are coming up. Property. Property is one of those things that you have to buy a property as such in order to live in it. And most of us will buy it as our residential property for ourselves. But just some tips to take away on this. Firstly, if you're a first-time buyer, using things like lifetime ISAs for your deposits is really useful. The government has given us an opportunity to save money into ISAs that are specific for buying property, and therefore they give us a bonus for doing that. If you're mortgaging or taking a remortgage, do shop around, and I'll show you on the next slide some of the examples of rates you should be kind of looking for out there. The reason why I say this, and to give an example myself, I used to work for NatWest RBS, and I effectively went to try and get a mortgage, and the offer that I was getting through the bank direct was beaten by a mortgage broker. And when I checked with the mortgage broker who the mortgage was with, it actually ended up being with NatWest. No sort of disrespect to them at all, but the reason why it was is because mortgage intermediaries or mortgage brokers get preferential rates because they're taking the risk away from the bank and they're also taking the cost away from the bank of doing the applications and processing and the checking, and therefore going through a broker can sometimes get you a better rate than if you went directly to a bank. So always shop around, always check to see where your best deal is going to come from. If you're using property as an investment, it's a great way of investing because you have bricks and mortar available to you. However, just be careful about the tax side of things and also the liquidity risk. So are you able to sell the property as quick as you may need the money out of the property? So if you are going to invest money in property, do just be a little bit careful with regards to that. With regards to mortgages, just be aware there's lots of different types of mortgages. So you've got repayment mortgages versus interest-only mortgages. There's different rates that you can get. So fixed, flexible mortgages, tracker mortgages, offset mortgages. So there's lots of different things you can get out there with regards to your mortgage. And also some of the things with regards to rates. Again, like I say, use a broker, use comparison sites. And the type of things to look for is, a 2-year tracker out there, just using some of the examples that we've got here. Would have been 1.52% in March and is 1.41% in December. So not too much of a difference there. And the same with the fixed as well. You can see the 5-year fixed as well is pretty similar across that six month or so period. The reason why I'm showing you that is because everyone says I'm going to wait for the rate to go up, I'm going to wait for the rate to go down or change or do something different. But actually, if you look at a 5-year rate compared to a 2-year rate, the difference isn't very different. And what that starts to tell you is that actually the banks aren't also thinking that rates are going to hike up so much over the next few years. So looking at a 5-year fixed over a 2-year fixed might be something that you want to consider looking at the rates that I can show you on that there. Again, take advice, speak to a financial advisor, and it will be, well, if you speak to a financial advisor, make sure you are comparing through different comparison sites at the same time. Guarantor mortgages is something that's available. And again, just wanted to point out to you that you can have a parent or a guardian or a relative guarantee your mortgage payments if you fail. It's a specialist kind of product. So if you are going to take it, just be careful. And also, again, the guarantor must be fully aware that they are protecting this mortgage for you. I've put in a quick table on here with regards to stamp duty, just to give everyone a refresher quickly on what stamp duty is. So when you buy or sell when you buy a property, you do need to pay stamp duty on it, depending on the value of the house. It works on a tiered basis. So if you bought £1 million property, you'd be paying some of it at 0%, some at 2%, some at 5%, and some at 10%. And anything over 1.5 million is obviously at 12% as well. So do take that into account when you're making a bid for your property. And also remember that there's other costs that will come into as well, things like conveyancing, removers fees, valuation fees. There's lots of other costs that may come in at various points as well. The last one, so number 7 that I wanted to talk to you about is just with regards to tax. Now, tax for me is half the battle in anything we do. The reason why I say that is if you can invest or put your money into a pension or something like that in a tax efficient manner, then actually you're already getting a better return than you would be getting if you just left the money in a bank account. The reason why, even your bank account interest is taxed after a certain level. So if you were to say put your money though into a high risk area that gave you 10% but was taxed at 40%, you'd still only end up with 6% in your hand. But actually, if you did a tax efficient investment through an ISA or something like that, and you did it into a medium risk level and got a 6% return, all of that 6% is yours. So you don't need to go chasing the 10% to be left with 6. You can just go out there and take a medium risk and get your 6% return. Now, there are lots of different people out there that will say to you, use this wrapper, use that wrapper, or use different tax efficient ways of investing. Again, it's individual to you, but always look to invest and put money away in the most tax efficient way. Give a quick example again. Lots of people at the moment are thinking, let me dabble into shares, let me buy some shares. Well, are you doing that via an ISA? Have you used your full ISA allowance for this year? If you haven't, why don't you buy those shares within an ISA and pay no capital gains tax when you sell the shares? Pay no income tax on the dividends because it's in an ISA. So just a clever little change like that could mean that you get more of a profit out of your investment than you would do otherwise. For employees, I always say check your tax code. Hopefully there's no one watching from HR that's going to get annoyed at me for this, but HR do make mistakes. They do make mistakes with regards to tax codes, and sometimes they're incorrect. And if it's incorrect, it means you're paying too much or too little tax, and you'll get hit with a bill later on. So do just be aware of what your tax code should be. For most of us, it should be 1250L. And the reason why that is the 1250 stands for the nil rate band that we all are entitled to. If though you've made some changes or you're getting some other incomes, then that could be slightly different. So again, everyone's is individual. Some other do's on here, make sure you do review the ownership of your capital. It may be that if you actually move money into your wife or your husband's name, who may be a lower rate taxpayer than you, then actually they could benefit from getting a tax-free allowance in that, or they could be benefiting from paying less tax than you. Remember, certain allowances can be carried forward and backwards. So capital gains, for example, if you've made a loss on it, you can carry it forward. And just be aware of your responsibilities on self-assessment. So if you have to complete a self-assessment form, make sure you are doing it. A couple of things to be aware about as well. Be careful in buying specific tax products. Tax products are kind of labelled out there, but very few and far between are they actually tax efficient products. So just be careful. There are tax wrappers out there, but very few tax products. Also, don't make your decisions just based on tax. Make sure the investment, the attitude to risk, and everything matches you first, and then look at, can I do this in a tax efficient manner? And just be careful about complex tax planning schemes. If it sounds too good to be true, it probably isn't true. So just be careful with regards to that. But again, I'm going to mention, make sure you speak to a financial advisor should you need to do so. My last slide, my second and last slide on tax just talks about the allowances and reliefs that you have. So on income tax, everyone has a £12,500 allowance. You have a capital gains tax allowance of £12,300. There's a dividend allowance of £2,000 and a savings allowance of up to £1,000 as well. If you put all that together, it means you could have an income of up to £47,800 a year and pay no tax on it. You've also got other reliefs, so pension contributions, where you can save up to £40,000 a year depending upon your income and various other things. And you can put £20,000 a year into an ISA. So there's lots of different things available to you where you can save tax or pay less tax. Are you using them all and are you aware of them all? That's something that you do need to consider and look into in more detail. The next slide is just talking about inheritance tax. And inheritance tax is something that will affect, I'd say, a lot of our communities just because of the properties that a lot of our families will own and would have handed down. I'm just going to touch on it very quickly today. And if there are future sessions that I can run, then I'm more than happy to do a more in-depth version of one on inheritance tax and wealth transfer planning. But essentially speaking, the first £325,000 of any estate is free from tax. That's something that you can pass down to your children, to anyone you want, and there'll be no tax to pay on that. Anything above that effectively is taxed at 40%. So, you know, it's a big old amount of tax that would need to be paid. There's a new allowance that came in from April the 6th, 2020. If you own a main residence, then you also get an additional 175,000 that's added to the 325, and that is per person. So if it's a husband and wife, 325 plus 175 means a £500,000 allowance. And between 100 husband and wife, like I say, there's two allowances there, so it's £1 million. Sorry. So you could have £1 million estate that can be passed down to your direct descendants, so to your children, and you'd pay no inheritance tax on it. But anything above that would be paid at 40%. So if you've got a £1.5 million house, £500,000 worth of other assets, actually your children could be paying a tax bill of around £400,000 on that. So just be careful, be aware of it, and there's lots of things you can do to plan for it. Firstly, there's things that you can transfer between your spouse or civil partner without paying any inheritance tax. So anything between husband and wife, there's no tax to pay. You can do what we call potentially exempt transfers or gifts, where you transfer or you gift assets to your children or to other people from now. Just be careful though, you do need to survive 7 years for the tax efficiency to really kick in on these things. And there's lots of rules and regulations with regards to how they can still be penalised. So do get advice if you're looking to do any of those gifting or transfers. You can make charitable gifts and that will reduce some of your estate value, but also if you give over 10% away, you will bring down the amount of tax that you pay to 36% as well. There's lots of annual exemptions and small gifts, things like if your children are getting married or grandchildren are getting married, you can give them certain amounts. You can give £250 to anyone you want in any financial year as well as a gift, but you've got to find a lot of people to give £250 to every single year in order to reduce down £1 million worth of assets. So yeah, just be careful again with how much of that you're giving away and how much you may need later on in life. And you can make gifts out of regular income as well, as long as they're regular and you're constantly giving the gifts, then it can be deemed as a regular gift, and therefore you won't get taxed on that. So there are some exemptions that I've quickly gone through. There's lots more out there that you can consider as well, but do get some advice on that as well. My final area to cover off today is just about wills and estate planning. Again, we've covered some of this before, but I do think it's really important to reiterate again that if you do have a will in place, make sure it's reviewed regularly, and that all your provisions that are on there are catered for, and that you have made sure that it's being left to the right people you want it to be. You're protecting your future generations effectively by making a will, so it's definitely something that you should do. Be careful about making homemade wills. You know, some people say you can walk into local shops, buy a will kit and write it. Yes, it does work to a certain extent, but it is better to speak to someone who is professional with regards to will writing and lasting power of attorneys, so that you get the right things in place for you, and you do consider everything there. Also think about leaving some of your stuff to your grandchildren potentially, rather than leaving it to your children. That way it doesn't kind of have double taxation on it. It means that the inheritance tax bill doesn't have to be paid by your children and then your grandchildren as well. You can pass it straight down to them potentially. Think about how you own your property. Can you get joint ownership in place, or tenants in common, or a variety of different things like that as well. And also think about a lasting power of attorney when you are doing a will. So what I mean by that, again, I mentioned it before, that's looking at the fact of if you were to not pass away but unable to make financial decisions, will you have something in place that will allow someone to make those decisions for you. The laws in Scotland and the laws in England are different, and England and Wales, sorry, are different, so just be careful of that as well. So your plan and choices and what you do next, well, actually you can take lots of the information I've given you then go and do it yourself, but don't confuse the information I've given you with advice today. It is just information, some food for thought to get you thinking. What I'd rather you all did is get some professional advice. There's lots of different advice companies out there. You can go to a company called, an online website called unbiased.com, and they will give you recommendations of local financial advisors. Or if you really want, get in touch with myself. You'll find me on Facebook. You can give me a shout, and I'm happy to have a conversation with you and point you in the direction of the right type of financial advisors if it isn't myself as well. So I'm more than happy to help where I can, but just conscious of the fact that I don't want to be inundated with 500-600 calls coming through to me. But it is really simple to get financial advice, but it's also just as simple to do it yourself. But if you do it yourself and get it wrong, it could cost you a lot more in the long run. So just be careful about that. For most people, I'd say get the advice to set it up. Once it's set up, you can then say, actually, I'll continue it on my own and continue to review it on my own, and only get advice as and when you need to. What can financial advisors help with? Well, here's a whole host of things. So you've got things like protection, retirement, long-term care or care home costs, inheritance tax planning, annuities planning, tax planning, capital lump sums, investments, pensions, mortgages, and full financial planning. So a financial advisor can help you with lots of different things in a face-to-face environment, on the telephone, and a lot of them are actually doing it online now as well. And this slide is taken from our company one, the Close Brothers one, because these are all areas that we can actually provide financial advice in. What's your action plan going to be today? And this is my last slide for today. Well, some of the things to think about and take away: review and manage your debts. Think about how much debt you have. Is it under repayment? Do you have a clear plan in place with regards to when it will be paid off? Review and maintain a rainy day fund. Make sure you've got an emergency fund. We talked about the 3 to 6 months worth of expenditure that should be available to you. Review and optimize your pension savings. So are you saving enough in? Do you know what it's going to pay you? Is it going to pay you enough when you need it? And ensure your protection needs are up to date. Things like your wills, lasting power of attorneys, life cover, critical illness cover, etc., etc. Make the best use of any employee benefits. Now, I know in our community, a lot of people are self-employed as well, but if you are employed, have you got some benefits that are coming that you can utilize through your company? And even if you're self-employed, what benefits can you get through actually utilizing your company benefits? And can you get discounts through having certain plans and policies that go through your business as opposed to directly through your personal account? And finally, review your budgets, your pensions, your debts, and your savings. Review everything. Make sure you do it annually, and make sure you are able to make changes as and when you need to. So thank you very much, everyone, for listening. Hopefully you found that useful. Once again, I can't reiterate enough the fact that that was not advice. That is me just giving you some information, some food for thought, and apologies that I continued repeating that. And again, I'll use that word, it's individual to everyone. Everyone's circumstances are going to be very slightly different. So thank you once again for all listening. If you do have any questions, then please do drop them into the box on the comments boxes. But I'm also going to invite Ami on again, and she is going to help me with a Q&A session now. So thank you all for listening. Ami, you there?
Hi, thank you, Ron.
No
thank you for that. I thought that was a really great overview, and I think you covered some really important topics. And I know from the comments on the various pages that lots of people thought so. And I think they'd like to see some more topics like this, focusing in on some of the things you've covered. So thanks again. So we've had a few questions, and if it's okay, I'm just going to start with those first of all. So one of them is from Umesh Raichada. So he's asking about basically investing in property versus paying into a pension pot. So say, for instance, he's paying 27% into his pension, and would it be a good time to invest in property, particularly in the current circumstances, or is the pension still a good kind of investment or place to put his money?
Okay, so ironically, I had this question from one of my presentations earlier today, literally the same thing, so it's ironic on there. But so I would always say that investing into pensions, because of the tax efficiency that you get in investing in pensions, it's still a good time to be investing in there. Yes, the returns that you may have got in your pensions over the last 3 or 4 months might look like they've dropped. It may look like your fund has dropped in value. But without taking too long to answer the question, I'll use a quick example on here that if you were to go down the pub and you were speaking with some friends and they turn around and said to you, do you know what, I invested money in the Lohana Community United Kingdom in the shares there, and I doubled my money in a week. It's human instinct to think, do you know what, I'm going to go do the same. Let me go have a look at the LCUK share price. I'm going to invest money in there, and you do it. But actually, it's the worst thing to do. Why? Because the gain's already happened. You've already missed the boat with that. What you should be thinking is, right, if I met that same person in the pub and they said, I've lost 50% of my money on there, you're thinking, I never want to go near it. That's what your natural instinct will tell you to do. But actually, it's the best time to go in because it's already lost 50%. It's at a lower point than it was last week. So the reason why I'm saying that is with your pensions, if you think, oh, I've lost money on them or they've not done very well lately, it's actually a good time maybe to think about putting more money in right now because the unit prices that you're getting are lower than what they were before. Therefore, you're getting more units for a cheaper price. So when it now starts to grow, as long as you've got 5, 10, 15 years left of your pension until you need to retire, as it starts to grow over the next few years, you'll have more units growing quicker for you. That compared to a property, it's difficult to give an exact answer because you know what? Property is bricks and mortar. It's shown over the years that it's always going to grow. And generally speaking, again, you will get good money out of a property over a period of time. However, tax efficiency is the big thing with property right now. And it's really difficult to invest money in property and take it out of property in a tax efficient manner. So I'd still say look at the pension benefits. And again, I'll use those words I keep using. It's individual to everyone. Different people will look at it in different ways, but for most people, saving into a pension is still going to be the right way to go.
So following on from that then, a question from Shivani Shah. Should individuals sign up to, say, employer protection plans or even retirement options versus private protection plans or pension plans?
Yeah, so definitely I'd always say try and look at your employer plans, and the main reason why is because your employer will make a contribution for you as well. So in a lot of companies out there will turn around and say, if you pay 3% into your plan, we'll pay 5%, or if you pay 5, we'll pay 10, etc., etc. So I would always say look at the options of your employee plan because they'll contribute, but also because an employee plan is for lots of different people. It's not just for you on a one-to-one basis. You'll end up getting discounts for it as well. So you got to think, if 500 people go to get a pension, they'll give a better rate than if just one person went to get a pension. So the charges will be cheaper on an employee plan or a group plan than on an individual one for sure. Okay,
and so from that, actually, those who work for the NHS, so Swarupa Dar reference, and she works for the NHS. So what would you say, one, about the NHS pension, but she also says that it's been changing and has changed several times over the recent years. And every time it changes, she feels like, am I losing out on this?
Sure.
So can you advise on the NHS pension at all?
Sure. So what I'd say with the NHS pension, obviously it's changed, and it used to be one of the most amazing pensions out there. And over the years, they've made slight tweaks to it. and it's not as beneficial as it was in the past. However, it's still a very strong scheme out there. So if you are still able to kind of save with that pension scheme, I'd say stick in it. Don't try and jump out of it or transfer benefits out unless you've got personal circumstances that mean that you have to. So I would still stick with it. At the end of the day, it's still similar to the answer I gave for the previous question. It's an employee's pension. So if you're getting a pension through your workplace, then I'd always say try and stick to the pension through your workplace. Yes, you will be losing certain benefits. It's happening to all pension schemes, not just the NHS. Even where I worked at RBS before, they made changes to their final salary pension scheme, but it was still a great pension scheme to be in. Even when I left, it was still a good pension scheme to be in. So yes, it is getting weaker, but it's still a good pension scheme to be in for sure.
So I work for the NHS as well. So when we get to retirement age, do you think we'll get something worthwhile back? Hopefully. Yeah,
so at the end of the day, you have to think about it as to how much you're paying into the pension scheme as to what you're going to get out of it. And I'd be really surprised, even with the NHS scheme or any scheme out there, that you're going to end up paying more money in than what you'll get out over your 30 or 40-year working life. Because you've got to think, like I showed you with that inflation page, money would have gone down had it not been invested. So even if you put in, say, £50,000 over that time and it ends up being 100,000, you still made a profit. It might not be sufficient for you, and that's a different question altogether. Is it going to be enough for me? Is a different question. But will it be a decent pension still? Yes, it will, compared to what you would have paid into it, for sure.
Okay. And then we've got, so we're going to move topic now, actually, for a question from Janisha Majidya. I think you mentioned about credit scores. And so she was asking, how is it affected, and where can she find this information?
Yeah, sure. So you can go to lots of websites online. There's things like ClearScore, there's things like Experian. There's different searches you can do on your own credit score. You pay a small fee and they give you the information on it. Like I said before as well, even in credit card companies, I know, for example, Barclaycard do it, where if you've got a Barclaycard, they give you a free credit score once a year. I think NatWest have started doing it recently as well. So there's a few companies that do that. The things that you need to be aware of were those things I went through on the kind of wheel that was on there. So things like your repayment history. So are you keeping up to date with all your payments on time? Your address history, your financial links to other people that lived with you. Also, are you on the electoral roll or not? And also how many applications and things you've done recently as well. So all those things will come up on your credit score, and it just gives you a number at the end of the day. And that number is a reflection of how high or how low your credit score is. So it's pretty simple to do. And you can do it, like I say, through one of the lots of different companies doing a Google search. You'll find it online.
Brilliant. And then an anonymous question. So if I don't earn very much money, is there a minimum amount needed to save for some of these plans to work, do you think?
Sure. I'll go back to that same word that I've used so much today, individual. It's individual to everyone. If you don't earn, or you feel you don't earn that much, actually compared to others, it's probably still more. And if you're saying to me you're in a position where you can afford to put something aside, even if it's £10 a week, £10 a month, £15 a month, it's still better than zero. You're still in a better position than someone who could be earning twice the amount you earn but spends all of it. So there's no right or wrong with that. There's no amount that's too small. Generally, though, if you're looking to invest money, you probably want to be looking to invest in the region of sort of £50 or more a month. Because anything smaller than that, you probably want to save it into a cash account first and then look to invest it in one go later on. So maybe once a year you do a sweep up and invest money, as opposed to constantly doing it just because of the charges and things that may be involved on the lower amounts. That's all. But
I guess it's your rainy day fund as well.
And your make sure your rainy day fund set up beforehand as well. Yeah, exactly. So no amount's too small though to invest for sure.
Okay, and another question from Sheila Gokani. So the stamp duty slide that you showed, is that based on the first property, or does that include the additional duty that you pay on subsequent properties?
No, that was just based on your first property. So that whole slide was all talking about first property and being your initial purchase that you bought. If you're buying a buy-to-let property or a second property, then there will be higher rates of stamp duty. Effectively, it's a 3% addition to whatever the standard rate was on that chart I showed. So yeah, it is higher for buy-to-let.
Okay, and then she asked, if you buy an investment property, are there different stamp duty rates? Now, as far as I know, that's not the case.
No, it's the same rates. It follows the same chart. It's just an addition of the 3%. That's cool.
And then a question from Rina Gokani, going back to pensions, actually. if you worked for a company, say 15 years ago, and you were putting money into the pension scheme with those, do they automatically contact you? Is that something you should be actively contacting them? And when do you do that? At retirement age or earlier?
Sure. So firstly, you need to make sure your contact details are up to date. So that's something you need to make sure that you do. But they will send you a statement every year. So if you're not getting a statement through from a pension from your previous employer or from other personal pensions that you've set up before, you need to get in touch with them to say, why am I not getting this statement anymore? It's your duty, it's your pension fund at the end of the day. It's the same as saying if you had a bank account, would you just kind of stop looking at it, or would you just leave it there and disappear? And do you think the bank's going to come after you, basically saying you've left your money here? They're going to do the same thing in the pension. They're not going to come after you. It's your duty to go after them. So they will send you statements. Like I say, make sure you're getting statements for every year. And if you're worried about it kind of getting lost in the past as such, what you can look to do is consolidate pensions. With the freedom of pensions now, you can bring them all together and invest them all into one place. And that way, you don't have this problem of having to look for 5 different statements or 3 different statements. Bring them all into your current employer's pension scheme. A lot of employers will allow you to transfer funds into there because at the end of the day, it just enhances that scheme as well.
Okay, thank you. And then I think a couple of final questions. From Tarun Radia. Any suggestions where to invest with the likely recession around the corner due to COVID-19? I'm guessing this is quite individual.
Yeah, it is individual again. But what I'll say with that is that, like I was saying earlier, with regards to if you were speaking to someone down the pub and they say they've lost lots of money, a lot of people around you will probably be saying that the market's down. There's lots of things that have dropped in value. I'm not going to sit here and give you individual things and say go and invest in this company or go and invest in that company, but the market as a whole is pretty low right now. It's recovered a little bit, but it's had some sort of bouncing around over the last few weeks. So I can't guarantee you it's not going to go further down. There's lots of shares and lots of companies that will go further down. But what I can say to you is if you look at something again in 5 or 10 years time, if you're prepared to invest for that longer period, then you will see good returns across whatever investment you do. So if you don't follow markets or you don't kind of have an idea of where to invest, the best thing to do is speak to a financial advisor and kind of get help on where to invest. Doesn't necessarily mean you need to pay them fees every single year. You could just get the advice you need, do the investment, and then come away and then manage it on your own going forwards. But if you're having to ask that question to say, where should I be investing my money? You need some advice on exactly where to do it in a formal way as well. Okay.
And then from Paresh Raja, he's talking about what would you recommend for income now that, say, income funds or trusts have cut their dividend, or some have suspended income dividends altogether?
So yeah, again, I probably need a little bit more information with regards to what they're looking at, but there's lots of different products available out there for income. So yes, income is lower. Savings rates are lower at this moment in time. But there are still guaranteed income bonds out there that will pay a guaranteed rate of income. There are still going to be companies out there that are, for want of a better word, desperate for money. And so will give you higher rates in terms of if you do corporate bonds with them. There's also government bonds, so the gilts that are available as well. So there's a variety of different places where you can get returns. It just depends on how high they're going to be and what you're looking for. If you're looking for a gilt, for example, to pay you 10% a year, a government bond to give you 10% a year, it's probably not going to happen. If you're looking for a government bond that pays you a couple of percent a year, you'll probably find it. So again, it depends on what you're looking for, how much you've got, and that will give you more sort of space as to where you can actually invest your money. But again, sounding like a broken record, but you really do need to speak to a financial advisor if you're looking for more specialist style products to produce an income for you, rather than just the traditional sort of shares and dividends that may come out.
Sure. And then last one, this is from me now, okay?
Yeah.
This is the one I thought of. So I guess when is the best time to start your financial planning, or equally if you're, say, in your 60s, like some of our parents, is it too late to start some of this stuff?
So the best time to start your financial planning was yesterday. You should have started it yesterday. It's always going to be as early as possible, but it's never late as well. So where you're saying about parents or grandparents, anyone like that, even if they're in their 60s, 70s, 80s, they're still going to have concerns with regards to inheritance tax planning, or they're still going to have concerns about do they not have enough money to actually survive for the rest of their lives. So there's always time. It's always a good time to plan. Even as young as, and I know you sort of said our sort of age, but actually if you think about even babies as well, And one of the things I didn't mention on the pension slide is that actually pensions are available for babies, which you might laugh at and think, what's that? But actually everyone in the UK, even children, have a pension allowance of £3,600. So as well as the ISAs and junior ISAs and kids funds and different things you can do, you can actually save £2,880 into a pension that will automatically get topped up to £3,600 for you. So again, it's just about understanding what options are available to you. There's lots of different things available to you, but you can plan for that at any stage of your life, be it a baby, be it 18, be it starting your first house, starting your first job, buying your first car, be it retiring, be it coming into a care home, be it even on your deathbed. There's still plans that you need to make for your finances. So you've always got to plan for your finances at any age. It's never too early, it's never too late.
Brilliant, thank you. So I think there may be a couple of late questions that we've missed, and if I have, I apologise. I'm sure, Ron, you might try and look back at the comments and just see if there's anything key that you can answer back there. But hopefully we've covered the majority of questions for now. So I want to thank you there and close off if that's okay.
Sure. Can I just say a couple of quick points as well, though, as well? So just from me, once again, just reiterating the fact that any of the information I've given you is just information and not advice. It is individual circumstances that would take that, and you do need to speak to a financial advisor. Use things like the internet to search for local financial advisors, speak to your friends, who do they trust, who do they work with, and get information from them. And then my final thing would just be to say thank you to all of the LCUK team, the LPN team as well. So Ami, yourself, thank you for hosting the Q&A session there as well. Sunil Bhai, to Bharat Bhai, to Jay for doing the IT side of things, and to Lena, who's also on the LPN team. Thank you guys for giving me the chance to do this presentation, and hopefully it was good for all of you and everyone enjoyed it. And if there's other bits people wanted me to talk about in the future, I'm more than happy to do it. And I will go through the comments for sure, Ami, and just kind of answer some questions that may be on there. So thank you all once again. Brilliant,
thank you. So I just want to say thank you again to Ronak. That was really interesting and actually absolutely relevant topics. And I know I've learned some things today as well. I certainly didn't know about starting pensions for babies. Thank you to you all for joining us actually, and for all your questions. I hope we've tried and we've covered as many as we can, and I apologise if we haven't managed to cover some of yours. If you have missed bits of this presentation, you will be able to review the live after a short while after the live has ended. So you can revisit either the Lohana Professionals Network page or even the Lohana Community of United Kingdom page, and you'll be able to do that. And I know the Young Lohana Society, also the North London page have shared this, maybe others as well. So we are working on our next event, and we hope you'll stay tuned. As soon as we have finalized the details, we'll be publishing those details. But do get in touch with us via our Facebook pages if you have any topics that you would like us to cover. I know that some of the topics within this talk would be quite relevant, and I know people would love us to focus in on some of those, so we'll aim to do that in the future. Do join our Facebook group if you haven't already, I would like to say thank you to the LPN team as well. Ronak's mentioned all their names, but there's a team of people who are behind this. Jay Ruparella working on the media side, Sonal Uncle, Bharat Uncle, our president and assistant secretary, and then Lena Soda, who's joined our LPN team and subcommittee, and we know the whole LCUK committee is behind us as well. So we hope that you've enjoyed today's event. We aim to have some hopefully non-virtual events in the future as well when it's safe to do so. But for now, good night and stay safe and well. Thank you.